There's this invisible force that's constantly at work in your life, whether you notice it or not. It's in the price of your morning coffee. It's shaping the value of your savings. It's even guiding the big decisions made by governments and central banks. We are talking about inflation. And in this explainer, we're going to dig into the paradox of why it might just be your money's greatest frenemy. I'm sure you've heard a story from your grandparents about how a candy bar used to cost a nickel. Well, that's not just them being nostalgic, that's inflation in action. And it's the answer to a really personal question. Why is that $100 bill sitting in your wallet today worth less than it was just a year ago? So, what exactly is inflation anyway? Well, at its core, it's pretty simple. It's just the rate at which the price of everything, goods, services, you name it, goes up. And the direct result of that, the buying power of your money goes down. That dollar in your pocket just doesn't go as far as it used to. And this is where things get really interesting. When inflation is high, cash basically becomes a hot potato. Nobody wants to be the one left holding on to it because its value is literally draining away. I mean, think about it. If inflation is running at 5%, any cash you're holding is passively losing that much buying power every single year. It creates this huge incentive to either spend your money or invest it, but definitely not to just let it sit there. So that brings us to this really weird paradox. While inflation feels like a penalty on your savings, for a government that's carrying a lot of debt, it can actually be a pretty useful, though controversial, tool. Let's dig into how that works. Well, according to some great research from the Penn-Wharton budget model, inflation helps government budgets in two big ways. First, over on the left, it helps inflate away the debt. See, unexpected inflation eats away at the real value of the government's outstanding debt, which makes it a lot cheaper to pay back down the road. And second, on the right, it acts like a hidden tax. If your salary gets a raise just to keep up with inflation, you haven't really gotten any richer, right? But that higher nominal income can actually push you into a higher tax bracket. They call that bracket creep, and it means you pay more taxes without actually having more buying power. Both of these things quietly help fill up government coffers. And listen, this isn't just a theory. Let's look at the evidence. This is our first photo from the album, so to speak. This table lays it all out. Just follow that bottom row. As the inflation rate climbs from 2.5% to 5%, the extra revenue the government collects as a share of the whole economy, it more than quintuples. The data is just crystal clear on this. Okay, so if it's a budget booster for the government, what's the problem? What's the downside? Well, as you can probably guess, there is a pretty big catch for the rest of us, for households, for businesses, and for workers. Yep, there's always a flip side. That soft default on government debt, well, for the households and investors who are holding those bonds, that's a real loss of wealth. That higher tax on capital we talked about, that makes people less likely to invest, and it hurts the value of business assets. And here's the kicker. The Penn-Wharton model finds that this drop in investment makes every worker less productive, which, at the end of the day, means lower average hourly wages for everybody. But hang on, because here's where the plot really thickens. It turns out that not all inflation is the same. The real game changer for investors and for the market isn't just inflation itself, it's whether or not that inflation takes everyone by surprise. This quote right here from Parametric Portfolio Associates, it just nails it. The market is always trying to look ahead, right? It's pricing in what it thinks is going to happen. So when inflation does what everyone expects it to do, traditional investments usually do just fine. The real damage happens when inflation comes in way hotter than anyone saw coming. All right, let's pull up our next key piece of evidence. This chart maps out 4 different economic scenarios. It's based on 2 things. Are we in a period of inflation or deflation? And was it expected or a total surprise? Now we're going to zoom in on that top right box, unexpected inflation. So let's break that down. Over on the left, you have expected inflation. Everybody sees it coming. Interest rates, stock prices, they've all adjusted ahead of time, so your traditional assets do okay. But on the right, you get unexpected inflation. The market gets totally blindsided. Suddenly, interest rate expectations have to change, and that forces a major repricing of assets. And for your typical stocks and bonds, that repricing almost always points down. And this bar chart shows you exactly what that looks like in the real world. During periods of surprise high inflation, U.S. stocks returned a pretty meager 0.74% on average per quarter. In bonds, even worse, at just 0.09%. But look over here at the star of the show. A diversified basket of commodities delivered a whopping 3.85%. This just perfectly illustrates how an inflation surprise can completely reshuffle the deck for investors. So, all of this complexity is exactly why central banks, like the US Federal Reserve, don't just let inflation run wild. They are actively trying to manage expectations and keep things stable. Which brings us to the big policy debate happening right now, all centered around that famous 2% target. This 2% number didn't just appear out of thin air. It was the end of a really long journey. After Fed Chair Paul Volcker famously tamed the super high inflation in the 1970s, the idea of having an official, explicit target started to gain ground. And after years of debates and folks like Ben Bernanke pushing for it, the Fed finally made the 2% target official back in 2012 to help keep everyone's expectations in check. But that was then. In recent years, especially with interest rates hanging out near zero for so long, economists and policymakers have started asking a really critical question. Is 2% still the right number for the economy we live in today? So, according to former Fed Chair Ben Bernanke, there are two main alternatives being kicked around. The first one, on the left, is simple. Just raise the target to 3 or 4%. The upside? It's easy to explain, and it would give the Fed more ammunition, more room to cut rates in a recession. The downside? We would all have to just live with the costs of higher inflation all the time. The second idea, price level targeting, is a bit more complicated. Instead of just aiming for 2% every year, the Fed would try to make up for past misses. So if inflation was only 1% one year, they'd shoot for 3% the next year to get the average back on track. It shows a stronger commitment, for sure, but it's way harder to explain, and some people doubt the Fed could really stick with it. Okay, I know we've covered a ton of ground here, from the cash in your wallet to the government's balance sheet, all the way to the high-level debates happening inside central banks. So what's the bottom line? What does all this actually mean for you? So what have we really learned? First off, just holding cash long-term is a guaranteed way to lose your purchasing power. Second, inflation is never neutral. It always creates winners and losers. Third, when it comes to your investments, the real enemy isn't just inflation, it's an inflation surprise. Fourth, trying to manage all this is an incredibly difficult balancing act for policymakers with no easy answers. And finally, and this is the most important part, understanding these powerful forces is absolutely key to making smart financial moves in today's world. And that leaves us with one last big question to think about. We know it can eat away at our savings and push down our wages, but it can also help governments manage their debt and give central banks the flexibility they need. So, in a world full of these complicated trade-offs, you have to wonder, is inflation the necessary evil that we just can't live without?